the lectures in the material tabs. You can go and find it, and then you can start the lectures. Everyone hear me? Good.
We can hear you, sir.
Okay, thank you. I think my internet is not so good. So, okay. So we can start the lectures in other conference. So today we're looking at lecture 4, but we get like topic 3. So we're looking at the monetary and financial systems and how the money and financial system are related to each other. And we know that the financial systems is part of our life. And financial market and institutions now they are actually a big part of our daily operations. And then, so this chapter we're looking at what is money, just a brief one, and then we're looking at the financial systems. Okay, so I think we already know what is money. Then, since your macroeconomic class, maybe. So money is a stock of an asset that can be readily used to make transaction. So it's just the overall definitions, general definition of money only. So money is actually an asset, um, and that people regularly used to buy goods and service from each other. So readily used to make transaction, meaning we use money for exchanging goods and services. For example, we buy a meal, a restaurant, or a shirt from store, for example. Then when we discuss about meaning of money, we always looking at a function of money. So we already know, we just go very brief. Money, we have 3 main functions. The first one is the medium of exchange. So the medium of exchange is actually we used to buy stuff. An item that, for example, a buyer gives to a seller when we purchase goods and service is an exchange. For example, you go to buy a shirt at a store and the seller gives you the shirt and you give the seller the money. So this is just a medium of exchange. And another function is the unit of accounts. So the unit of another function is the store values. So a store value is an item or function that people can use to transfer the purchasing power from the present to the futures. So for example, if you go to the stores, the seller accepts your money today in exchange for a good or service, or in exchange for a shirt, for example. And the seller can hold the money and become a buyer of another good and service at another time. So money is not only the store value, but it's also transfer the purchasing power from the present to the futures by holding, for example, stock or bond is also in terms of purchasing power transfer as well. So the seller that accept your money, they can become a buyer of another items. So it's just the transfer of purchasing powers. And money can be in the forms of non-monetary assets such as bond and stocks, because this one is actually a form of you transform the purchasing power from present to the future as well. And the last function of money is the unit of accounts. So the unit of account of money is a yardstick that people use to post prices, price tag, for example, and recorded income, recorded debt, for example. So it's a common unit by which everyone measures price and value. For example, when we go to shopping mall, we buy a shirt that costs $50 and a burger that costs you $5 US. So it's just a yardstick that everyone uses to measure price and values in this case. And in terms of unit of account, for example, if you go to the banks and you take out a loan, so they will ask you how much you want to borrow, like $1,000. So it's actually $1,000 is the size of the money or of the loan that you need to repay in terms of dollars. They're not in they're not measured in, for example, goods and services. No, for example, they're not measured in like 1 tons of rice, for example. No, so it's just a yardstick that people use to post the price and the value of their monies. So this is a simple start with the definition of money, and then there's a lot of changes in the payments system. So payment system, so that there's an evolution of what we mean by money's credit, for example. So we used to be in barter periods that money can be in the forms of commodities like gold and silvers, other commodity like rice, for example. During barter, we exchange commodities as a representation of money. And then we create paper currency or fiat money like we have nowadays. Then there's a checks develops electronic means of payments and electronic money, debit, store value, and smart card, e-cash, for example, like Visas, MasterCard, and even the e-cash. So money have evolving nowadays. And then money facilitate transaction in the economies. So what we call the mechanisms. So the mechanism that conducting such transaction is called payment systems. And the payment system has evolved over time from relying on the payment made in gold and silver coins, for example, to payment made by paper currencies, check written on deposit and bank, to payment made by electronic fund transfer. So before, for example, we use gold, and then we have the coins, and then we create a payment system that exists in terms that transaction or exchange good and services in terms of paper currencies. And then we develop checks, and then we develop electronic fund transfer by you are not you do not need to bring or hold money to your seller. For example, you're just doing the payment by electronically fund transfers. And in in Industrial Revolution 4.0, we already know that the technology has enabled or facilitated payment systems. And the central bank usually is the regulate is the body that supervise the payment systems, but it doesn't have a directly control it because many payments are processed by banks and other private firms. But we do regulate them by having regulation law, for example. And there are 5 most desirable outcomes for a payment system of a country. So the first one is that it's in terms of speeds. So the payment system nowadays have created a fast settlement of payment that facilitate transaction by both household and businesses. So for example, If you go to shopping mall, you want to buy food, for example, nowadays really easy. Probably you just have your phone and the money in your account, you can tap it and that you pay. And businesses, they just use electronic fund transfer to each other. It's fast. And the second one is the securities. So we have seen several episodes in which the criminal have hacked into the retail credit card systems and other part of the payment system. And it's a concern about the cyber securities. So better security increase consumer and businesses confident that the funds will not be stolen electronically. So it's also encourage bank and the payment service provider to focus more on cyber securities in order to maintain or to keep confidence from the consumer and businesses. Then the third one is the efficiency. So the results that devoted to processing paper checks or currencies or other aspect of payment are devoted from producing other goods and services. So increasing the efficiency of the payment system allows it to function using fewer workers and computers and other capital, which benefit the economies. So you know that the paper checks or the paper currency, maybe we use it by exploiting the other capital of the economies. So the efficiency of the payment system or the development of the payment system also benefit the economies to more sustainable ones. The fourth one is the smoothing international transactions. So the increasing amount of the business that take place across borders. So you know that in the 20th centuries, we have an increasing in globalization, increasing in terms of interconnectedness, in terms of trade, in terms of financial, international financial markets. So there's a lot of businesses that taking place across the borders with the rest of the world. So those can be facilitated if the payment system can be made quickly and conveniently. So the payment system has smoothed the international transactions. And the last one is effective collaboration among participants in the system. So the payment system, they actually need to efficiently involve the government, the financial firms such as banks and other businesses around the world. And such involvement to ensure that we have a smooth transfer of funds in transactions. So that's why I mentioned earlier that mostly the central bank is the one who supervises the payment systems. Any questions? Um, we just looking at, as I mentioned, you already know about what is money and how it functions. We just go very quick. So this is just an example in the US. This how money supplies measures. Um, so the first one we have currency, C. So we have M1. So M1 is just the currency plus the money deposit plus travel checks and other checkable deposits. So this is how money supply in an economy is calculated. And this is just an example from the US. So each country, we have different measurement of the money supplies. So in that we have M2, which is actually the M1s plus the small time deposits or saving deposits, money market mutual fund, money market deposit accounts. So actually, if you see here, actually the M2 in the US is just the total of everything in the systems. And as I mentioned, each country will have different measurements of money supplies. And now if we are looking at how the money or the money supplies related to the economies, or what is the importance of money in the economies. So it's in here, we're just looking at the monetary aggregate in the US. So in the US now, they also have the M3s. So they have M1s, the green one, they have M2, the blue one, and green one is the red one is the M3. So this is the monetary aggregate in the US. So M3 is actually just the total of M1 and M2, the red ones. And then how that monetary aggregate is actually important or related to economies, and why we need to study money, or why we need to study monetary policies, and why it related to financial systems as well. So the first one, we're looking at the money and the business cycles. And the business cycle is actually just an upward and downward of the movement of the aggregate output they produce in the economy. Or we say the business cycle is actually just the fluctuations of um, the economic growth in the economies. So you can see that the blue line is the money growth, or the monetary growth rate, M2. So, and then you see these shaded areas is actually it's actually indicate about the up and down of the economics cycle or business cycle. So when the output, for example, or when the economy is, when we have a economic growth, we see we say there's a increasing in the economic growth or boomings. But for example, when we have a crisis in the shaded area here, it's actually representing recessions or the decline in the economic growth. So you see that if you're looking at the monetary growth rate, for example, the trend between the monetary growth, the money growth, and the business cycle is actually uh, 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 related to each other. So when you see the rate of money decline, so you see that so for example, we see in around the 1950. So you see that every recession, you will see there's always the rate of money growth decline before every recessions. So the shaded areas actually represent recession or crisis. So you see that every recession, before every recession, you see the money growth is declining. You can, this one, you see the money is declining. This one also, and this one is a whole declining. During the 1970s, also declining. So every recession actually has been preceded by the decline in the money growth, which indicated the change in the money supply might also be a driving force behind any business cycle fluctuation as well. However, not every decline in the rate of money growth is followed by a recession. So the change in the money supply might also be a driving force behind economic fluctuations. But not every decline in money growth rate is followed by a recession. So I think probably you have learned in monetary economic causes about the change in the quantity of money to the change in the aggregate economic activity and price level. That's why I think I'm not going to talk much into detail about um, how they're related to each. I mean, what is the phenomenon behind that? So I just provide you an explanation on in a general level, in terms of general theories only. So what are that? So we're looking at the relation between money and price levels. So you see this graph showing about the red one is the money supply M2 and the aggregated price level. So in here, so in order to, I'm not sure you remember the theory in macroeconomics. So to calculate the price level, either you can calculate it in terms of inflations or, I mean, CPI index, or you can calculate it in terms of GDP deflators. So both GDP deflator and CPI index tell us about the trend of the price level. The only difference is that GDP deflators calculated only what the country produced, while the CPI, it measures good and the consumers the consumer baskets. Mean they calculate everything from both domestically produced and from imports. So that's the difference, but it both tell us about the price level. So in this case, you can see that um, um, the inflations tell us about the price levels. And you can see that when we have a higher money supplies, it's normally coincident with the rising in inflations as well. So you see, both of them are actually go together. Only at some point that when the money supply go higher, the price level just go a little bit. But what it the but what the graphs tell us is that when you increase the money supply, you may increase your price level. I mean, the price level in the economy might be increasing as well. So for example, if you keep printing the money, now your domestic currency or the money is becoming less valuables, then everyone just go and showing for goods and services. So the demand for goods and service in the economy is increasing, which lead to the increase in the price levels. And another one is the money growth and inflation. So this one is actually just interrelated with each other. So you can see this is the example of cross-country data. So you see that when the month on the x-axis is the average money growth rate, and on the vertical axis is the average inflation rate. So you can see, for example, Brazil, when they have about 220 money growth rate, the inflation rate is about 200. Belarus as well, Russia, Romania, while some country like the United States or UK, for example, when they have lower average money growth rate, they also have lower inflation rate as well. But this is just one part of the um, uh, so you can see that there is a positive association between inflation and the money supply growth rate. Country with higher inflations, also the one that has higher money growth rate as well. So that's why the policies, the monetary policy is important for the economies. And what is the relation? And then we're looking at the money and the interest rate. So in addition to other factors like business cycle, like inflation, price level, money also play an important role in interest rate fluctuation as well. And interest rate fluctuation is a great concern to business and consumers because they need to expand their businesses. They need the fund from the banks, for example, or from financial markets. Consumer, they want to, for example, um, take out a mortgage loan. They also need to borrow the money from the banks. So interest rate is a great concern for the economies. And this graph show you about the changes in the interest rate on long-term treasury bond and the rate of the monies. So this one is the interest rate on long-term bonds, the red one. On the right-hand side is the money growth rate, the blue ones. So you can see that when the money's growth rate rising, for example, in 1960 and 1970s, the long-term bond interest rate also increasing, but not just as much as the increasing in the interest rate. So this is what they tell us about the relationship between interest rate and the uh, monies. So that's why, because money can affect many economic variables that are important to the well-being of the economies. So that's why the policymaker throughout the world really care about monetary policies, which is the management of monies, the management of the interest rate, which is, and you already know that it's mostly under the central bank. So you can see the interest rate, the inflations, the price level, the business cycle are the important economic variable that can affect the well-being of the businesses and the consumers. And then we have another relation between fiscal policy and monetary policies. So we already know that fiscal policy involved in the decision or the policy related to government spending and tax collection policies. So the government can be meeting, for example, budget deficits. So you can see here, in here is the budget deficits. So which is the government have higher expenditure over the tax revenues for some period. And then we have a surplus that the tax revenue is exceed the government expenditures. So in deficits, government must finance by the borrowing abroad, while a surplus lead to a lower government debt burdens. So you can see this one representing the economic growth or the percentage of GDP, which is measured by the aggregate output. So in the US, you can see the budget deficit decline. I think during 1950s, which is less than 3% of the GDP. And then in 1990, it's like over 5%, around 5% of the GDP. So we have about 2000s. We have a surplus from the US have the surplus from 1999 to 2001. And then after if you remember, in 2001, we have a terrorist attacks. So the budget has go again into the budget deficits. So actually, during that time, the central bank have introduced a lot of expansionary monetary policies to accommodate the fiscal policy and the budget deficit as well. So this is how the money or the monetary policies play an important role in the economies. any questions? So because we were looking at the financial system, and then now we're looking at how the bank get the monies and how the financial system are related to monetary policies. So in here, we're looking at actually banks, they they are the one who collect the deposit from the depositors, and they also borrow money. They also have a debt. So the owner of the bank, they must also invest their own money in the banks, which called the bank or equity. So for a bank, the total equities, is actually the deposit plus debt, and the bank funds is actually the liability plus capitals. So this one, the capital here is their own capital, their own equity, and the liability is actually they get from the deposit and the borrowing fund from others. So since the bank fund are kept in the bank as a reserve, so the bank fund they also used to make loan, and the interest charged from loan is actually one important source of income. And the bank is actually they can purchase securities, and purchasing security is also the source of income that because they earn interest. So on the bank balance sheets, on the asset side, you will see they have reserve, they have loan, and they have security and others assets, which I'm not mentioning here. So this is the liability, which is deposit and funds plus deposit plus borrowing. The equity is actually the liabilities plus the capitals. And the bank asset is the reserve plus loan and the securities. So the bank role in the monetary systems happening here. So as we looking at earlier, the money supply is actually equal the currency plus the demands deposit. We can representing here by money supply M equal currency plus deposits. So since the money supply include the money deposit, that's why the banking system play an important role in the economies. So we will see briefly how money is created in the systems. We have reserve. The assumption we have reserve, we represent R, which is the portion of the deposit that bank has not lent. So a bank liability include deposits, asset include reserve and loans. So under the 100% reserve banking, a system in which a bank hold all deposit as reserve. And we have a fractional reserve banking, which is bank they hold a fraction of their deposit as reserve. So you have heard about the reserve requirements. So, or we could say we have fractional reserve banking systems. For example, if we say the reserve requirement is 10%, it means if the banks, they take in 100 deposits, $100 deposits, that means 10% reserve requirement tell you indicated that the bank had to keep $10 of their 100% deposit in their bank's vault to protect or to maintain or to withstand any withdrawal in the future. So that is the fractional reserve banking. So in here we have three scenarios. We have an economy that has no banks, an economy that have 100% reserve banking, and an economy that have fractional reserve banking. Three scenarios here. And in each scenario, we assume that we have currency in circulation up at 1,000 US dollars, which is denoted by C, capital C. So in scenario one that we have no banks. So without banks, meaning the deposit is zero. So the economy without bank, meaning the money supply just equal to the money in circulations. In here we have 1,000 US dollars. So the money supply in an economy that has no bank is 1,000 US dollars. And in scenario 2, we have an economy that using 100% reserve banking. So initially we have currency in circulation of 1,000. We have deposits zeros, and then money supply is 1,000. And now suppose the household, they deposit $1,000 at First Banks. So after the deposit, now the money in circulation is zeros. The deposit at the bank now is 1,000. The money supply still 1,000 US dollar. So in an economy that they implement 100% reserve banking, there has no impact on the side of the money supply, because they just take out the money in circulations and put it back in the bank. So the money supply is just still 1,000 US dollars. So if the bank, they hold all the deposit as a reserve, bank actually do not influence the money supply at all. In the 100%, if the economy is implementing 100% reserve banking. So we're looking at the scenario 3, which is the most practical ones, I think. So suppose that the reserve requirement from the central bank is 20%. So it means the bank holds 20% of the deposit in reserve, and it can make loan with the other 80%. So now, for example, the first bank, they make 800 in loan. So we know that the customer deposit 1,000, and then they hold 20% a reserve. So 20% is 200, and then the rest 800 they can make loans. So the money supply now equal to 1,800, because depositor have $1,000 in demand deposit, and the borrower hold 800 in currencies. So the money supply in an economy is now 1,800 US dollars. So in a fractional reserve banking system, bank is actually creating monies by giving out the loans. So giving out the loan just meaning you give the monies to the borrowers in this case. So the reserve ratio, or the economy that implement fractional reserve banking systems, they influence the money supply in an economy. So that's why how the monetary policy and the financial policies or the financial system are related to each other in this case. So for example, now suppose the borrower that they take 800%, 800 US dollar here, and they deposit in second banks. So now in second bank balance sheets, they have deposit of 800 because of 20% reserve requirement here. So 20% of 800 is 160. So the bank can loan out another 80%, which is 640. And then people who take out this loan, they deposit in the third banks. So the process keep going the same. So at the end of the process, the economy is more liquid in the sense that there is more in terms of the medium of exchange. You can see that the money now is multiplying. So the money supply in the economy totally probably 5,000 in here because the reserve is 20%. So at the end of the process of the money creations, So we see that when the first bank they loan out the monies, it the borrower they just uh, it means that they just give some currency to the borrowers, and then the borrower just deposit in the second bank, and the borrower from the second bank they just put the money in the third bank. So the economy is more liquid because in terms of the medium of exchange. So that's why we say a fractional reserve banking system, they create money, but it doesn't create wealth because the bank loan, they give borrowers some new money, which is actually a debt. It's not a wealth at all. So even though we see the money is created, now the economy is more liquid, but it doesn't mean that the economy is wealthier than before because we create money in terms of we have more medium of exchange, but it doesn't mean we create wealth because the borrower that they take out the loan from the bank, they just actually they have new money, but the money is just actually the debt or the borrowings. It's not an assets. I mean, it's just a debt. So that's why even though the fractional reserve banking this system they create money, but it doesn't create wealth at all because the loan that the borrower have is not their asset. It's actually the debt. Any questions?
Teacher,
Yes.
uh, here it say create where it does it refer to like the standard of living?
Um, it's not specifically in terms of the standard of living, actually. In some part, they can borrow money. I mean, the borrower, they borrow money. They can have ability to buy goods and service, which partly maybe improve the living standard, but actually not totally with that. That's why uh, we say it's not about, I'm not saying it's about increasing your living standard because sometimes if you borrow money, but you are on default, you cannot pay back the money, you may face some issue on defaulting. So that maybe ruin your living standards. You know what I mean?
Teacher,
So
so
that's why I use the word wealth rather than the living standard.
may you define wealth here? What does it refer to then?
So the wealth here, uh, so for example, the borrower, they are, when the bank they give money to borrowers, it means they give the borrowers some currencies, which is they have the ability to expand their business, to buy goods and service, for example. But you remember that the borrower is also taking on debt. And in some case that the loan maybe do not make them any richer. So a bank, they create the asset of the money, but they also create a corresponding liabilities for those who borrow the created money as well. So even though they have money, but at the same time, they also have liability as well. So wealth meaning they can the loan may not make them any richer at all. That's why it doesn't create any wealth. But they use borrowing money just to smooth their consumption or to expand their business. But sometimes it doesn't create wealth. As I mentioned, sometimes customer can default. may I answer your questions?
Yeah, teacher, thank you.
Yes, thank you. Any other questions? So we're looking at the monies and its notions. So now we're looking at the financial systems because the course is about international finance. So we're looking at the financial system specifically. So what is the financial system? So the financial system is that it's just the collection of institutions that facilitate the flow of funds between lender and borrowers. And so this is just a flow of funds through the financial system. So you can see this flow, we have indirect finance and direct finance. So we have lender or savers, which is household, business firm, government, and foreigners. And then we have borrower and spender, which is the same. Can be business firm, government, household, and foreigners. So the financial system consists of indirect finance and direct finance. The indirect finance is actually facilitated by financial intermediaries, while the direct finance happen in the financial markets. So those who in exceed of money, those who sell can give money to those who need it or the borrowers through either indirect finance or either direct finance. Whether they go to a bank, they deposits, and then the borrower, they go to the banks and take out the loans. Or the seller can buy the stock or can buy the bond in the financial market, which is directly to the borrowers. So for example, Apple's, Microsoft, Google, for example, they sell their stock or they issue the bonds. And then for those who have money, they can go to the financial market and buy Apple stocks or bond, for example. It's just like they give money to the firm. They give money to the companies directly, but not uh, through the bank or financial institutions. And the financial intermediary also can fund the financial market by buying the stock or buying the bond as well. So you can see the banks or investment bank, commercial bank, they can buy stock or issue the stocks, bond in the financial markets. That's what I mentioned from the graph. We say we have direct finance, which is the borrower. They borrow directly from the lenders in the financial market by selling financial instruments, which actually the claim on the borrower future income or asset. While the direct finance is the borrower, they borrow indirectly from the lender through the financial intermediary, usually banks, financial institutions, and by issuing financial instruments, which are the claim on borrower future income or asset as well. So it's so issuing financial instrument just actually like loan, a mortgage loan, a commercial loan, or consumer loan, for examples. So the financial system, as I mentioned, can represent savings and investments. And when people earn income, they typically don't want to consume the entire income all at once. So this is in terms of the behaviors of the household. So they may have no idea what to do with the unconsumed incomes. So this unconsumed income is called savings. And then we have investments. People that who may to wish to spend money on various projects but they either has no money of their own, or they may wish to spend their personal fund on a project other than their own. So the money that these people need for their spending plan is called investments. So the financial market, it makes easier for lender or those who have saving fund and borrower for those who need the fund to fund each other's. So both groups actually benefit when the financial system do its job well. And when the financial system fail, both lenders and borrowers suffers. So could anyone tell me why when there is a failure of the financial system, both saver or both lender and borrower suffers? Can anyone tell me about this?
Sure, I think when the market fail, the borrower they cannot make money, so they cannot pay back the loan to the lender, and the lender they don't have their payment, so they cannot take this payment to spend on other thing or loan or pay for their own loan or loan to other that will borrow from them. That
Yeah,
is, yeah, that
yeah,
is
that's
idea.
correct. Yeah, thank you. And yeah, it's correct. And also, probably the borrowers doesn't have money to expand a business anymore when they want to expand a business, but because the financial systems fail, no one deposit at the bank, as you mentioned, they have no money to spend to lend. So it's like a cycle. So both groups suffer actually, even the economy as a whole. Yeah, you are right. And so, and here we're looking at the structure of financial market. I talk about specifically here because we will talk about financial intermediary in the next lectures. We're looking at the commercial banks. That's why I've just picked up a point only here on this lecture only on financial markets. So we have several bases for classification of the financial markets. So we have um, the financial instruments, which is either the instrument can be in terms of the debt instruments or the equity instruments. So the debt instrument is actually um, such as bond or mortgage, for example, which is the agreement, the instrument that the borrower paid the holders the instrument with fixed amount of dollars at regular intervals, both interest and principal payment, or and until a specified maturity date. So this is the debt instruments. So those who issue debt instrument like bond, for example, they are borrowing the monies. So it means that those who hold the debt instrument, those who hold bonds, they will receive payment from the issuer at a regular interval until a specified maturity date. For example, if you buy a bond like 5 years maturity, so you will receive an interest and principal payment at a specified regular interval until the 5th year, until the maturity date. The equity instruments, such as common stocks, is actually another method of raising fund in the financial market. So the equity instruments is actually a claim to share the net incomes, which is the income after the firm deduct all the expense and tax. And when you buy an equity instruments, or when if, for example, if you own or if you buy a share of common stock in a companies, mean that you are entitled to to get the firm net incomes, or we call it dividends. So Equity often make periodic payments, or I say dividend to the holders, which are considered as a long-term security because the stock, they have no security date. So this is the difference between debt instrument and the equity instruments. And we're looking at another so actually we have for example, if you own, and we're looking at the financial market in terms of the maturity dates. So the maturity date, we have a capital market, which is usually a long-term investment, and the money market, which is usually a short-term instrument exchange in the markets. So if you want to look for those who have a short terms, usually you go to a money markets. Some debt instrument also short term, less than a year, like treasury bill, for example. And then for those who are looking for like a long term, more than 10 years or longer, they should go to capital market, which is like a long-term bonds, for example. And the financial market, we can also looking at in terms of the security of the issue. So whether the issue in primary market, well, it's a financial market that's for a newly issued security or a newly issued bond or stocks. And they are sold to initial buyer by usually the corporation or the government agencies to borrow the funds. Sorry, and we have the secondary market, which is the financial market in which the security that have been previously issued can be resold. So usually the primary market for security are not well known to the public because they are the selling of the securities from the initial buyer, and usually the primary market takes place behind the closed doors. And for examples, and then for those who buy the initial stock issues, they can sell it in the secondary market. So that the secondary market usually is publicly available for everyone in this case. And usually in practice, a financial institutions that exist the initial sale of the securities in the primary market, we call them the investment banks. And you can see we don't really have an investment bank here. So in the US or in other countries, they have investment bank. And what they're doing is they underwriting the security. It guarantees a price for a corporation or firm security and sell them to the public. So we do not have an investment bank here, but we have a security firm that act as underwriter as well. Some bank they have a subsidiary as a securities underwriter, as a security firms like Campu Bank. They have a Campu Lombard, Cladar Bank. They also have a Cladar security firm. So those are the firms that have underwriting the security for the primary markets. And you already know that the agent for the investor, we have a broker and dealers. So broker are the agent or the investor who match the buyer and the seller with the seller of the security, while the dealer, they link the buyer and seller by buying and selling security at the stated price. So we have the agent in the financial market as well, the broker and the dealers. So in here, we will looking at more specifically. So as I mentioned, the debt instrument is the contractual agreement that the borrower pay the holder of the instruments with fixed amount at a regular interval at the maturity date. And the debt instrument can be short term, which is less than a year, a long term, which is more than a year, but probably intermediate term within 1 and 10 years. So short-term debt instrument like treasury bills and long-term instrument like bond, for examples. And then we have equity instrument, usually common stocks, as I mentioned before, is actually the claim to share the net income. And the payment is in terms of the dividends. So the stock, they has no maturity date, and owning the stock means you own a portion of the firm, and thus they have right to vote on issue important to the firm and elect its directors. But I'm not going into detail into what type of stock that you can write, you have the right to vote, or what kind of stock you don't have right to vote, because we are not looking into that details. And then, as I mentioned before, we can classify the market by maturity of the securities. So money market is those usually short term, less than a year. Capital market is a long term, more than a year. Long-term equity and debt instrument, which is, I mean, if you want to look for a long-term equity and debt instrument, you should go to capital market. If you need a short-term instrument, you need to go to the money market, because it's where the short-term instruments are traded. And then, as I mentioned, we have primary markets, where is the market that the new security or the new issue of the security sold to initial buyers. And we have investment bank, which is the underwriter security in the primary market. Then we have the secondary market, which is the market that sells the previously issued stocks. And we have the agent in the secondary market, which is the broker and the dealers. So we're looking at the structure of the financial market. Then now we're looking at some fact about financial structures. I think so. There are several facts about financial structure. I think 8. So the first one is actually stock are not the most important source of external financing for the business. And we'll be looking at also the example of why the stock are not the most important source of external financings. And then the second one, we have issuing marketable debt and equity instrument is not the primary way in which the business finance their operations. They have other way that they can finance their operation as well. Number 3, indirect finance. So let me restate it again if you have missed something. So number 1, stock are not the most important source of external financing for the business. In this case, because we have so much attention in the media that focus on the stock market, especially in the advanced economy or those who have developed financial markets. But actually, only a small fraction of external financings in business are actually from the stock market. And a large part of their financing is actually from the borrowing from banks. Number 2 is that people believe that issuing marketable debt and equity securities is not the primary way in which business finance their corporations. So the fact that issuing marketable security is not the most important source of financing is actually true in the world. So other countries that they have smaller share external financing, they supply by the marketable securities actually. And then we have number 3, the indirect finance. So indirect finance, which involves the activity of financial intermediaries, is many times more important than direct finance, in which business raise fund directly from the lender and in the financial market. And in this case, it actually depends on the country's economic structures. For example, in advanced economies, it's actually not the case. While in the developing economy, that might be the case because in developing economies, direct finance is not really highly developed. I mean, the financial market is not highly developed. So the business could not raise funds directly from the financial markets. So in the developing country, indirect finance is actually more important. While for advanced economy, it's true that direct finance is actually play a more important role. For example, those in the United States or in other developed economies. So the first one is the mention about financial intermediaries, particularly banks are the most important source of external fund used to fund the business. And again, it might be true for some part of the world, while it might not be true in the other part of the world. So, for example, in the United States, there are even people maybe banks are more important in the country that are not so developed like the United States. For example, in developing countries, for sure, banks play an important role in the financial system uh, in terms of external fund to finance the business. So again, this fact actually depends on the country economic structures. And then we have number 5. They mentioned that the financial system is among the most heavily regulated sector in the economies. It might be true as well because the government regulate the financial market or the financial institution because they want to promote the provision of the informations. They want to protect consumers and they want to ensure the stabilities of the financial systems. And this number 6, they mentioned that only large, well-established corporations have easy access to security market to finance their business. It might be true because individual and smaller business are not well established. They usually, like for example, the family owned and they are not have a proper accounting system. So usually if you want to borrow the money at the banks, or even you want to issue a marketable security in the financial market, you should be the large corporations or a corporation that well established. Number 7, they mentioned that the collateral is a prevalent feature of the debt contract for both household and business. So collateral is actually a property that is pledged to the lender as a guarantee for payment in the event that the borrower is unable to make that payment. So actually collateral is actually predominant for mostly in terms of household debt. Because, for example, you want to take out a loan, you want to take out automobile loan, for example, car, or you want to buy motorbike, for example. Usually those car or those motorbike, it's pledged as collateral. If you want to take out mortgage loan, for example, usually you have to have collateral to pledge with the banks so that they can give you the mortgage loan. And then we have number 8 is that the debt contracts are typically extremely complicated legal documents that place substantial restriction on the behavior of the customers. So the reality of the debt contract is, in practical, is a little bit different. So the restrictive covenant are not just a feature of the debt contract for business, but even for the personal loan, home mortgage are also require the borrower to maintain a lot of documents. For example, some banks, they even require for insurance. If you want to take out the loan to buy a car, they even require you to have a, an insurance as well. So it actually depends on country, depend on the situation. So in here, we will examine the impact of the transaction costs. We're looking at how the cost and affect the financial market that provides solutions to these 8 facts of the financial structures. I think before we continue, I think we should have a 10-minute break here. Is it okay?
Yes, teacher.
Okay. So the next part, we'll be looking at the solution to those facts when we come back. Okay, so I think we can continue so that we can finish on time. So what I mentioned earlier is actually like a puzzle um, that we need to solve in order to understand how the financial system works. Because as you know that the financial system is a complex structure and functions throughout the world. And we already see that the financial system, it includes different type of institutions, different type of instruments like bank, insurance company, mutual funds, um, bond market, for example. So those are complex structures. So this eight fact or puzzle is actually we need to solve in order to understand how it works. And by solving this fact or these puzzles, the first problem that we need to see is the transaction cost. And the transaction cost is actually is a major problem in the financial market. And we will see how the transaction costs influence the financial structures. So for example, if now you have 5,000 US dollars and you're thinking of you want to invest and you think about investing in the stock markets. So because you have only 5,000 US dollars and then you can buy only a small number of shares. For example, the share costs $50 per shares. So 5,000 meaning you can buy just 100 shares. And then the stockbroker tell you that your purchase is so small that the brokerage commission for buying the stock you pick will be large percentage for the purchase price of the shares. So when you hear that, you even pay higher commission than the price of the shares. You decide to buy a bonds. And the problem in buying a bond is even worse because usually the smallest denomination for some bond that you might want to buy is, let's say, 10,000. Sorry, so I must write 10,000 here. So you do not have much to invest. And as a broker, they're not interested in your business at all because you have small size in your account that it doesn't make them worth to spending time with you. So you see that you are so disappointing and you are not able to use financial market. So then and now you face a problem. The problem that you're facing is actually the transaction cost because you have only a small amount of fund available and you can make only a restrictions number of investment. So the transaction cost can hinder the flow of funds to people with productive investment opportunities. So we will see how the intermediary reduce the transaction cost. So financial intermediary make profit by reducing the transaction cost. So what they can do is the first one, the solutions to high transaction cost is the economic or the economy of scale. They taking advantage of economic of scale by reducing the transaction cost per dollar investment as the size of the transaction increase. So for example, they can invest in a mutual funds. So mutual fund is actually an example of financial intermediary that provide economy of scale because they sell share to individual and then invest them in bond of stock market. So people they come together to mutual fund, they put money in the mutual funds, and then the mutual funds pull all the monies and invest it in a bond of stocks. So because the mutual fund they buy a large or huge block of stock or bond, mutual fund can take advantage of lower transaction costs. So the cost saving are then passed to individual investor after the mutual fund they taken they can buy when the mutual fund take the so usually if you invest in mutual fund you have to spend on management fee for administration, for example. Then if the mutual fund they have a lower transaction cost, they also lower the cost of fee for those who invest in the mutual fund as well. So this is one solutions that people can solve to transact high transaction costs in the financial markets. So increasing in diversity of individual investor also reduce their risk and making them better off. So both mutual fund and the investors, individual investor is better off in this case. And the second one is they develop an expertise to lower the transaction cost. So the financial intermediaries are also better able to develop an expertise to lower the transaction cost. For examples, the expertise in computer technology will enable them to offer customer convenience service like they're able to call or for informations how well their investment or are doing and writing on their accounts. So an important outcome of the financial intermediary in lower transaction costs is the ability to provide consumer or customers with liquidity service that make easier for them to conduct transactions. So again, for example, in mutual fund again that we talked earlier, they only they not only pay shareholder with high interest, but they also allow them to write check for convenient bill payment as well. So in this case, if you get back to fact number 3, actually indirect finance involve a lot of we can use expertise in solving the indirect finance, the puzzle number 3, which say that indirect finance involve many more, which is more important than direct finance in raising the fund. So that expertise can provide investor with liquidities as well. For example, if they invest in the money market mutual fund, for example, not only those they can pay shareholder high interest, but they allow them to write check as well. And expertise, for example, in computer technology will for in financial intermediary, we enable consumer to enjoy the service for convenience service, for examples. For example, you can see the banks now in Cambodia, for example, ABA, they develop their expertise in electronic transfers, fund transfer. So actually it helps to lower the transaction cost for consumers. So now you don't need to go to the bank. You don't even need to go to the bank to open your account. You just use your ABA app, for example. You can pay but just tap, for example. So this lower the transaction cost for the consumers. And the next part, so we know that the presence of the transaction cost in the financial market explain why the financial intermediary and indirect finance play an important role in financial markets, as I mentioned here. So why we say indirect finance many times more important, because it can help us to reduce the transaction cost. But to understand the financial structure, we also looking at the role of the information in the financial markets. And when we're talking about the role of the information, usually people are talking about asymmetry information, adverse selection, and moral hazards. So I think if you study in the previous course, maybe You have heard the word. So when we study the introduction of finance, we usually assume that the word is having symmetry informations. It means that the case that all the party into a transaction of a contract have the same information, or just a little bit more or a lot more. In many situations, in realities, that's not the case. And we refer this in as asymmetry informations. Asymmetry informations can take in many forms, and usually it's quite complicated. So asymmetry information is that when one party doesn't have enough knowledge about the other party that involved in the transactions. And it's really important for the financial markets. So asymmetry information, for example, the manager of the corporations, they know themselves that whether they are honest or whether they have better information about their business. But those who buying the stock, they don't really have much information about the corporation. So that meaning we have asymmetry informations. And in order to later to understand what is asymmetry information, we focus on two specific forms. The first one is adverse selections, and the second one is moral hazards. So the adverse selection is an asymmetric information problems that occurs before the transaction occurs. So adverse selection occurs when one party in the transaction has better information than the other party. And the adverse selection happened before the transaction occurs. So for examples, potential borrowers might likely to produce adverse outcome and are the one most likely to seek loan and be selected. So for example, those who have a bad credit ratings are actually the one who actually seek the loan. And the bank that they provide the loan to those peoples, they are the one to take the risk, and they are the one to experience adverse selections, because the adverse selection might increase to those big risk taker, because a loan might be default and the lender doesn't know about that. So that's why you see that currently in financial market, in financial intermediary, we're trying to minimize the notion of adverse selections. For example, in Cambodia, we have CBC, we have credit bureaus. So credit bureau is the place that you can find your borrowing histories, whether you are late payments, whether you are on default. So the bank, if they want to lend you money, they can go to credit bureau to avoid any adverse selections from any big risk borrowers, for example, in order to minimize their credit risk. So that's one example of adverse selections. And then we have another notions. It's the moral hazards. So the moral hazard occurs when one party has an incentive to behave differently once an agreement is made between the party. So moral hazard is actually occur after the transaction occurs. So the lender, for example, run the risk that the borrower will engage in activity that are undesirable from the lender point of view, because they make it less likely that the loan will be paid back. So for example, if the borrower they already obtained a loan, they may take in a big risk that possible have a high returns, but also run a greater risk of default because they are playing with someone else's money. Because when they borrow the money, when the bank lend out the loan, we already know that the money is actually from the saver. It's actually from someone else's money. So the moral hazard lower the probability that the loan will be repaid. And the lender may also decide they would rather not make a loan. So the hazard that the borrower has an incentive to engage in an undesirable or immoral activity and making more likely that they won't repay back the loans. Moral hazard can also happen, for example, when the central bank, usually when we discuss about lender of last resort, we need to do it very carefully because when central bank, they bail out any banks, when they decide to bail out any bank, they need to do it really carefully because bailout may also create moral hazards. Why? Because when a bank, they engage in risky activity, they think when they fail, the central bank will protect them. The central bank will protect them from failures. So because they see from the history that the central bank used to bailouts, used to protect a bank, they may have an incentive to engage in any undesirable activities. So that's why you see during the GFCs, the Federal Reserve decide to let go some of the big banks in the US because they want to avoid moral hazard. They want to signal the system that you are not always protected by the central bank. So that's another example of what we mean by moral hazards. And the analysis of how asymmetric information problem affect the behavior is actually known as agent theory, agent principle theories, and then we'll be looking at in the next slide as well. So any question about asymmetry informations?
No question, teacher.
Okay, good. So now we're looking at some examples of how adverse selection can influence the financial structures. So this is just a case that it's just an examples. So we already seen the characteristic of adverse selection problems that it may interfere the efficient functioning of the financial market. So in here is a case studies from the famous Nobel Prize winner, which is referred to the lemon problems, because it resembles the problem created by the lemons in the used car markets. So in the used car market, it's actually the potential buyer of the used car are frequently unable to access to the quality of the cars. And that is, they can't tell whether a particular used car is a good car. And this will run well, or a lemon that will continually give them a grip. So a lemon problem in used car, for example, as I mentioned, we can't distinguish between good and bad or lemon used cars. And we are willing to pay only an average of good and bad car values. So the price that a buyer pay must therefore reflect the average quality of the car in the market, somewhere between the low value of the lemons and the high value of the good cars. So good car won't be sold, and the used car in the market will function inefficiently. So what helps us avoid this problem with the used cars? So in here, because we cannot distinguish, we are willing to pay the average quality of the car in the markets. So then a car that has low value usually is a lemon or bad car. And a car with high value is always a good car. And because we are buying in, we are involved in the second car markets. Usually we want to buy a car with average price. So because the good car has a higher price, usually the good car won't be sold in the used car market. And the lemon, so that what happened in the used car market is the bad used car that have higher demand because they are in average price. And then the good car cannot be sold, so the used car market will function efficiently. So we will see how we can avoid these problems. So we also have, so for examples, the owner of a used car is more likely to know whether the car is a good or a lemon. So if the car is a lemon, the owner is more happy to sell it at the price that the buyer is willing to pay. And if it is so when the buyers, the willingness that the buyer willing to pay is actually between a bad car and a good car, and usually should be greater than the bad car values. But if the car is a good car, the owner know that the car is undervalued by the price that the buyer willing to pay, because even your car is good quality, but you are still selling in the used car markets. So the buyer is actually undervalues your cars. And the owner of the good car will not want to sell it. So as a result, this adverse selection, very few good used car will come to the markets. Only the average quality of a used car, or even the lemons or a bad used car that come into the market. That's why the market will not efficient in this case. Now we see a lemon problem in security markets. So a similar problem arises in security market, that is the debt instrument or the equity instruments. So as investors, we cannot distinguish between good and bad securities, and we are willing to pay an average of good and bad securities. So in this case, it's the same as the used car. What happened in the used car? So the good security is undervalued and firm won't issue them. And then the bad securities is overvalued. So there will be many people that issues the lemons securities or the bad securities. So in this case, similarly that the financial market will not working very well. We're not working efficiently as it should be in this case. And number three is that the investor won't want to buy bad security at all. So the market doesn't work well. Explain what happened in fact number one and fact number two. In fact number one, we say stocks are not the most important source of external financings. And that's why indirect finance more important indirect finance because of this ones. Because the investor don't want to buy bad securities. And it also explained fact number 6 that less asymmetry information to well-known firm, so smaller lemon problem. So in fact number 6, only large well-established corporations that have easy access to security market to finance their activities, because only those big firms or well-established corporations, they are well known, everyone know about that. For example, they have proper accounting standard. They have transparency and disclosure. They disclose their financial statement every year, so everyone know about that. So less asymmetric information to well-known firm, so there will be less lemon problem in the financial market. So that's why you see there's an issue in access to finance for the SME in most of the country, probably in Cambodia as well, because you know the SME usually they do not have proper accounting standards, proper accounting records. They do not, and usually family owned. So for those who lend the money, you see that they are reluctant to get the money. And even they want to get the direct finance in the financial market, no one will buy them because we don't know about those firms. Oh. So what can we do to help solve the adverse selection problems? So there are some tools that we can use to solve the problems. So the first one is the private production and the sale of information. So the solution to the adverse selection problem in the financial market is to eliminate asymmetric information by furnishing people supplying funds with full detail about the individual or firm seeking to finance their investment activities. One way, for example, to get this material is to seller and lender is to have private company that collect and produce information that distinguish good from bad from then sell it. So for example, we have a credit rating agencies, Standard & Poor's, Moody, for example, that they collect the company information and they produce informations. They put on the ratings for the company so that everyone can know. They get the information about firm balance sheet position, investment activity. They publish this data. They sell it to subscriber, investor, for examples. So the system of private production and sale information is actually help for some part, but they're not completely solve the adverse selection problem in security market because they may also have what we call the free riders problems. So free rider problem occur when people do not pay for the information and take advantage of the information that the other people have paid for. So the free rider information suggests that the private sale information will be only a part of the solution to the lemon problem actually, because there may some company, some people, they just take advantage of the information of the other people. And then we have number 2 is the government regulations to increase the informations. So we also can avoid free rider problems and eliminate all asymmetry informations by government regulation. So the government can require the institutions to produce enough information to provide disclosures and transparencies. That's why we have, for example, security exchange commissions. So usually country that having financial market, usually they have the creation of security and exchange commissions in order to regulate those security firms, adhere to accounting standard, for example, disclose informations, and so that they can minimize the adverse selections problem. So for those security firms, for those that they issues the stock, they require from the Security and Exchange Commission to publish their annual audited reports. So that's why this can be one way. So government regulation is one of the tools that have solved the adverse selection problems. Then number 3 is the financial mediations. So the analogies to solutions of the lemon problem provided by the used car dealers, avoiding the free rider by making private loans, are financial intermediaries. Because the financial intermediaries is believed to avoid free rider problem, to avoid adverse selection, to avoid asymmetric informations. Because the bank, when they want to give out the loan to the borrowers, they do a lot of credit analysis, credit standard analysis. That the famous one is, for example, 6Cs. They're looking at the ability to pay, they're looking at the payment history, they're looking at the business, they're looking at the collaterals, and now we even have the credit bureau. So the bank gather all the informations that the borrower has before they decide whether they should give the loans to the borrower or not. So for us as a sellers, we do not know about the borrower situations. We just put our money in the banks and let the bank do the works. So it helps us to solve the problems of adverse selections. So that's why large firms are more likely to use so that's why for those small SMEs, small business, they more like go to indirect financing by financial intermediary, and the large firm, they are more likely to use direct finance because they are large, they are well established, everyone knows, they don't really have much lemon problem. But a small firm, they cannot get the external financings in the direct finance because everyone will not know about him. Not everyone know about the firm because they're small, so they just go to the banks to get the external financing. So that's why in developing countries, banks has a greater importance in the financial system. You can see in Cambodia, about 90% of the financial system asset is concentrated, is dominated by banking systems, while the rest is insurance and securities markets or financial markets. And number 4 is actually collateral and net worth. So the adverse selection is actually interfere with the functioning of the financial markets, that if the lender suffer a loss when the borrower are unable to pay. So that's why when you want to borrow from the bank, they require to have collaterals. So collateral is, as I mentioned before, is actually a pledge that the borrower has with the banks, had to put it at the banks. For example, if you have your mortgage loan payment, the lender will take the title to your house as a collateral. And then if you fail to pay your mortgage loan, they will make auctions for your house to get the payment, to pay off the loan, for example. And they also have a net worth or equity capital for the business. So for the household, they require collaterals. And for business, they also need to looking at the net worth or the capitals. So the net worth is actually the difference between a business or a firm assets, what it owns or what other own to them, and its liability, what it owes. what is need to pay to others. So a net worth can perform a similar role as a collateral as well. A firm that have high net worth, then they can engage in investment that cost that that have even because I mean a firm that have higher net worth, even they engage in activity or project that give negative profit, the lender can take title to the firm assets, the firm net worth and sell it off, for example. Maybe the proceed from the projects. So in this case, when the banks, they want to lend the monies to household, they normally looking at the collaterals. And when they want to give it to the firm, they're looking at the net worth. Or sometimes they even require for some collateral as well. And that can, if you're looking at the fact number 7, sorry. So the collateral is the prevalent feature of the debt contract for both household and business, because it can solve or it can minimize the adverse selection problems. So this one is just a summary of asymmetric information problem and tool to solve them. Adverse selections, tool to solve them is the, as I mentioned, private production and sale of informations, government regulation to increase information, intermediations, and collateral and net worth. And moral hazard in equity contract is the same thing, and moral hazard in debt contract, we require collateral, monitoring, enforcement, effectual covenants, and financial intermediation, which is also mentioned about the explanations to the fact, the 8 fact that we have here. Any questions?
Not for now, teacher.
Okay, I'm not sure if you understand, or probably you can ask me when we come back next week. So what usually the financial system would do, they serve multiple purposes. They help entrepreneurs to find money that needed to turn their business, to expand their business. They help entrepreneurs to pursue business projects without having to rely on their own money. And sometimes it also helps entrepreneurs to pursue business that without having to carry too much risk associated with their project as well. It can help to protect lender from irresponsible borrower, as we mentioned, adverse selections. It helps to foster economic growth by channeling the saving to more valuable project and cutting off the fund for the less value project. So they provide, they minimize the asymmetry information, the adverse selection, and the moral hazards. And it can foster economic growth by channeling savings to what can provide valuable to the economies. So, but there are also financials. So we are now looking at the financial development and economic growth. As I mentioned before, financial system can also have the economic growth as well. But so then financial repression can lead to low growth. So there's connection, there's a linkage between financial development and economic growth. And financial repressions can lead to low growth. Why? For example, we have poor legal system, we have weak accounting standards, we have government direct credit or state-owned banks, we have financial institutions that are nationalized, and we have inadequate government regulations. So this can provide a major disruptions to the financial system as well. So we're looking at the financial crisis and the aggregate economic activities. So our analysis that affect adverse selection and moral hazard can also assist in understanding financial crisis, the major disruption in the financial market. And then the result is the inability of market. So the result of the financial market is the inability of the market to channel the fund from saver to productive investment opportunities. So the factor that causing the financial crisis is actually, for example, maybe involved in there are factors that can trigger financial crisis. So the first one is increase in interest rate. So we see that individual and firm with the riskier investment project are exactly those who are willing to pay high interest because they believe that high interest provide them high returns. When the market interest rates are driven up sufficiently because there is an increase in demand for credit or because of the decline in the money supply, so the increase in interest rate can be from two channels, either because there is a demand for the funds or maybe because the central bank implementing contractionary monetary policies by lowering the money supplies. So the good credit risks are less likely to want to borrow, while the bad credit are still want to borrow. So those with the bad credit rating, they still want to borrow because they believe that higher interest rate will provide them higher profits. Because of the resulting increase in adverse selection, lender will no longer want to pay loan anymore. So the substantial decline in lending will lead to substantial decline in investment and finally the economic activities in this case. So when there is an increase in interest rate, maybe some bad borrowers still want to borrow bad credit ratings. Because bank also fear of adverse selection. When they see that even the interest rate is increasing, but he still want to borrow. So maybe they are a bad credit rating, so they no longer want to make any loan. So then now you can see there might be a decline in borrowing in the economy. Decline in credit growth in the economy. So there might be the case that there are no more fund available for investment. So that might lead to lower economic growth as well. The second one is increase in uncertainty. So an increased uncertainty in the market, in the financial market, probably, due to some failure of the financial or non-financial institutions, a recession, a stock market crash make it harder for lenders to screen good from bad credit risk. So the result of inability of the lender to solve the adverse selection problem make them less willing to lend, and also lead to a decline in credit growth, investment, and thus economic growth as well. So for example, there is a failure of the Lehman Brothers that make the lender more stringent in providing the loans. So there might be uncertainty. The investor now pursue that there might be uncertainty in the financial market, in the financial system. So they are not willing to invest in any investment, and the bank will not want to lend anymore. So there are no more fund available for investment. Then the economic growth also lower as well. Third factors, probably the asset market that effect on the balance sheets. So for example, the stock markets effect on net worth, unanticipated deflation, or cash flow effect that have an impact on the balance sheets. So for examples, in an economy that inflation has been moderate, for example, in industrialized economy, so many debt contracts are typically long maturity with fixed interest rate, and then you will see that there deflations or decline in aggregate price levels. Because the debt payment is fixed in nominal terms, so the decline in price level or the deflations will raise the value of the firm liability in real terms because it's increased the burden on the debt, which is that does not raise the real value of the firm assets. So that's why you will see the asset market effect will have the impact on the firm balance sheet, does impact on the economic growth as well. The first one is the problem with the banking sectors. Because we know that banks play a major role in financial market because they are the one who were positioning in information producing activity to facilitate investment in the economies. So any problem, a bank panics, for example, bank failure can cause problem and can occur, can provide contagions in the financial systems. So for examples, depositor, when there is a failure in the banking systems, even the failure is one bank, but as a depositor, we are fear of the safety of our deposits. So we don't want to put money in the bank anymore. We want to withdraw the money from the banks. So now you see that just a failure of one bank is actually contagious. Even the bank A fail, but the contagious may go to the other bank in the systems because everyone fear of their monies, the loss of their monies. So that's why we will talk about that in the more detail in the next lectures. And the last one is the government fiscal imbalance. So in emerging market economy in histories, like for example, Argentina, Brazil, they have government fiscal imbalance and it creates fear of default of the government debt. That's why the government may have trouble in getting people to buy its bonds, and it might force banks to purchase them. So those countries, because they have fiscal imbalance, so investors are not confident to buy their bonds, though, so they cannot raise monies to finance deficits. So only they face the bank to purchase them. So when there's a problems, when the government default, for example, it will substantially weaken the bank balance sheets and lead to contractions, lead to contagions in the banking systems, and thus cause to financial crisis as well, and cause lower economic growth in the economies. Any questions?
For now, teacher.
Okay, I'm not sure. So now we're looking at a case study of U.S. financial crisis. So U.S. had a long history of banking and financial crisis from 1890. For example, here. So the figure here is actually show you about the sequence events in the financial markets. So you can see that the typical financial markets, we have deteriorate deterioration in bank balance sheet, increase in interest rates, stock market decline, increase in uncertainties. So the solid arrow trade the sequence event in typical financial markets. Here, the solid arrow, and the dotted arrow show the additional set of events that occur if the crisis develop into a debt deflation. So this factor can create adverse selection and moral hazard problem worsen, economic activity decline, bank panic, adverse selection and moral hazard even worse, economic activity, economic growth even decline. It probably unanticipated decline in price levels. Then we have another worsen adverse selections. So economic activity even worse. And it may have a debt deflation. It developed, so from financial crisis, develop into the debt crisis. And I think in the US, they have several crises that began with deterioration in bank balance sheet, a sharp interest rate, stock market decline, and uncertainty increase. So the result in the financial market, but it also spillovers because when the economy activity decline or economic growth decline, you will see the deflation we also anticipated. So the sharp decline in price level or deflations will develop into a debt deflation as well. In this case, because the deflation will further deteriorate the firm net worth because of the burden of the indebtedness. And when the indebtedness, when the debt deflation happen, it also push further to pressure on economic activities, which means the economic growth can remain depressed for a long-term period of time. And the most significant examples is the Great Depression, which is the most economic contraction in the U.S. histories. I also raised some emerging market economy financial crisis as well. So we have 3 countries that show our country shift from a pop and high growth just before the financial crisis. And important factor was the deterioration in the balance sheet due to increasing in loan loss. Country in Mexico, East Asia, and Argentina. So in Argentina, particularly interesting, they had a well-supervised banking system, but the fiscal problem of the government weakened the banking system balance sheets when the government forced the bank in Argentina to buy the government bonds. So the confidence in the government fell, and the banks, because they're buying government bond and now the government are not able to pay, they have depressed values in the assets. So the asset value actually fell dramatically in Argentina. In Mexico, it's actually, in Mexico, in East Asia, actually, we do not really, we at that time, we do not have a really well supervised banking system, unlike Argentina's. So what happened in Mexican is actually by rising international interest rates. So Argentina actually having both rising in international interest rate and the global, the government fiscal imbalance. So the rising in international interest rate led to interest rate increase in Mexico and Argentina, and also accompanying in increasing in asymmetry information. So the stock market decline will also the mix. So that's why in Argentina and Mexico, there simultaneously happen two factors. One is international rising in international interest rate and the government fiscal imbalance. East Asia, we also experiencing the stock market decline as well during the East Asia financial crisis. So I think we gonna end the lectures here. Any questions before we end the lectures? So for those who are looking at the crisis, this probably maybe tell you something or tell you where to look at as well. That's why I'm not going to detail about what happened in those crises, what happened in Mexico, what happened in East Asia, or what happened in Argentina, Mexico, because we're going to have a presentation on those issues. From your group presentation, I mean.
Sure.
Yes.
May you explain again about debt and equity instrument?
And equity insurance. Sorry, for the which one? So, what is your questions again? Sorry.
In the financial instrument, may you briefly explain equity and debt
Right.
instrument?
This slide.
Yep.
So, as I mentioned, debt instruments is a contractual agreement. So, for those who issue the debt instrument like bonds or treasury bill by the US, it means that they have the obligation to pay the holder of the instrument. They have the obligation to pay those who buy the bonds. So in the debt instrument, usually, for example, in a bond, they have mentioned a fixed amount of payment that the issuer has to pay. For example, monthly, quarterly. So the fixed amount is actually the interest plus the principal payment. And usually on the debt instrument, they have a specific date. For example, they issue a 10-year bond, for example, or a 5-year bond or 1-year treasury bill. So they have to pay the borrowers, they have to pay the holder until the maturity date. And the type of the debt instrument, either long-term or short-term. So usually we mention about short-term and long-term debt instruments. So this is a debt instruments. We have equity instruments, which is probably, for example, common stock or preferred stocks. That's why I'm saying I say that I'm not going into detail common stock or preferred stocks, but those stocks are the claim to share the net incomes. I mean the income after the firms or the company deduct the expenses and tax. And for those who buying the common stock or it's actually for those who issuing the equity instrument is actually an asset of the business, which is the difference from the debt instrument. If you issue a debt instrument, it's actually a liabilities. But for equity instrument, it's actually an assets. And payment for equity is actually in terms of dividends. And stock, usually we don't have maturity date. And owning the stock again, you may have the right to vote, or it means you own a portion of the firm. And you may have the right to vote depend on which stock are you buying, common stock or preferred stocks. And that's why I'm not going to talk into detail. And you can see that between debt and equity, they both have advantage and disadvantages. For debt, you may have a fixed amount. You receive a regular fixed amount of payments, but you also at the risk of the government, the firm, or the corporation get into default. You are not able to pay. For equity, I mean, you are not able to be repaid or get back your monies. For equity, the payment is not fixed because it depends on the net income of the corporation. That's why we say it in terms of dividends. Dividend means it's depend on the net income, and the net income is depending on how well if the firm, how well if the corporation is doing. So the payment from equity instrument usually not fixed, but the advantages probably you have the right to vote and you own a portion of the firms. So that's the difference between debt and equity markets. So that's why, for those who are risk takers, they usually buying stocks. And for those who are like on risk aversions, they usually buying bond because it gives them the fixed amount of payments. Any more questions? Am I answer your questions?
Yeah, teacher, thank you.
Okay. Any other question or follow-up question or comments? Again, we are looking a little bit specifically on financial market and not financial institutions. As I mentioned, we were looking at financial institutions separately in the next lectures, and financial institutions that we going to cover is only for commercial bank only because the case for Cambodia, commercial bank is dominant in the banking system. That's why we should be more practical on that. So any last questions? You can ask me when we meet next week. Can go back and digest the informations first. And any question regarding to the assignment actually is going well. For your assignments?
Starting to look for suitable topic.
Okay. I hope you have a good discussion among the group, and so for group 1, I hope you have a good preparation for your presentation as well. And because we are not looking into detail about the crisis in this lecture, we are looking forward to your presentation to group 1, group 2, group 4, and group 6, I think.
Teacher.
Yes.
About written assignment, can we use a linear model?
You can use any econometrics that you learn.
Okay.
whether linear regression, multiple regression, anything that you know. I'm not like restrict on the methodologies. I mean. So actually, it's a yes.
Teacher, I have sent you the outline of our group assignment since
Oh,
we were not sure whether we could go with the new topic or not.
okay. Let me check. Sorry, my Telegram is flat of messages. So can you tell me the one who sent me the message, the name?
From Chiu-Mei, teacher.
Okay, I will look.
Around 8 in the morning, teacher.
Oh, okay, 8. Okay, I got it. So I will be looking at the outline and I will give you the comment. Sorry.
Yeah. Another
Yeah.
teacher. Teacher, and
Yeah.
about the written assignment, do we have to present it or not?
No, 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 no. You don't need to present.
Okay, teacher. Thank you, teacher.
Okay, any other questions? If no, we can end the lecture here. And I forgot to mention that actually I take the attendance for after I end the lectures. So usually they will give me the attendance list after I end the lectures. I'm not sure for those who leave earlier. I'm not sure if you have. So let me check the attendance list. So make sure you join the class from the beginning until the end, so that you don't miss any attendance. Okay, so thank you for today. See you next week. And don't forget, please, you can ask me any questions on your assignment or on the lectures. And we are trying to respond as soon as possible. So for me, I will looking at it soon and respond back. Okay.
Okay, teacher.
Yeah. So good luck everyone and have a nice dinner.
Goodbye, teacher. See you next week.
Goodbye.